I'm your host, Neeraj Shah. We're continuing with the conversation of whether this is the time to check in or check out. And in lieu of in the series of those conversations, the final one for this week is with Rajesh Bhatia of ITI Long Shot Fund. He joins in right now to talk about uh, what is his prognosis or his reasons for the view that he'll present to us today. Rajesh, great having you. Thanks for joining in.
Pleasure. Pleasure is all mine.
So, Rajesh, prima facie, in a nutshell, are you bearish? Are you bullish? Are you neutral currently?
So in a nutshell, I would say the risk return is not attractive after the 16, 18% rise that we've seen in the equity markets. I don't think that the challenge is really the Indian economy. I think our trajectory is fine. And in fact, the momentum is good. If you talk to corporates, I think their confidence is really high. I think with commodity prices coming off, they're feeling a little more comfortable, expanding in the post-COVID phase of growth. Having said that, I think the challenges are really more global in nature. And given that we are now at the high point of valuations relative to emerging markets or developed markets, given the challenges that we're going to see from the international markets, I don't think the risk return is attractive. So in a nutshell, risk return is not attractive.
Okay, great. Now let's expand that a bit. I heard you mention that India is fine, but the challenges on the globe might come about. There are too many out there.
Sure.
What are the top one or two that you think will have the biggest bearing on how risk assets perform and why?
Sure. So I think the more important one, according to me, is really the global slowdown. I think if you look at China, it is struggling for growth. I think 25% of the GDP is really real estate, which is struggling at this moment. And I don't think they want to stimulate that further. I think about 20% or thereabouts is really their exports, which is also suffering given global growth is a challenge. So China, which is 18% of world GDP, is struggling. You know that Europe is struggling because of the availability of gas, and therefore, I don't think there's a question of if there will be a recession, but when will there be a recession in Europe? And US, given the inflation that it is seeing, the Fed believes that there's no choice but to reduce the economic momentum. And if you add up all of these, US, Europe, China, Japan, that's probably about 60, 70% of the world. By the way, I think 70 odd countries in the world are today feeling debt stress. So that's the nature of the world today. We've seen that in Sri Lanka, Pakistan, or even Bangladesh. But there are 70 other countries which are feeling the debt stress. So global growth is really a challenge. And if global growth slows down, it will certainly have an impact on India as well. I think you've seen that in the export trajectory for us. I mean, you could include or exclude the export duty cut effects also. But regardless, I think the momentum is slowing from a global growth perspective. And we don't have the tools to stimulate demand because we've used all that up when the COVID struck. So our fiscal deficit went up to now about 6.5, 6.6. So we no longer have the luxury to stimulate our economy if we are suffering global growth. So that's, I think, the number one challenge that I think we will face, as you move forward. But Indian markets may be a little late to recognize this because, like I said, the current momentum is reasonably strong. And rightly so. I mean, I think, look, the best place, if you look around the world today, I think you're going to see that India probably is one of the best placed. We don't have structural problems that China, Europe, even America or Japan have. So as a $3.5 trillion economy with a balance sheet of corporates, which is very healthy, balance sheets of banks, which are very healthy, of consumers, which are very healthy, there is a structural opportunity of growth in India. That being said, I think in the shorter term, we are going to face these cyclical pressures from global markets. So my number one concern for the shorter term, which is visible right now, is global growth, which will impact India. Of course, my number two concern for India is oil and energy inflation, but it is not as much visible today. But that's my second concern, which I think can damage our story as we move forward.
So actually, on energy, both oil as well as I believe thermal coal, for example, right, are not quite showing the downtick that a normal economy would have, right, Rajesh? One could argue that crude is actually lower than what it could be, if China were normal. But be that as it may, it's not buckling down, so to say, because of various factors. Does that pose a major challenge for the world as well as for India? For the world in terms of the kind of cost that they have to pay, and for India in terms of really the impact on the CAD and the forex reserves, so to say.
No, absolutely. I think I totally agree with you, Neeraj, that thanks to China that at this moment oil prices are where they are. Otherwise, it should be headed higher. Look, what has happened is that we are heading towards, again, oil demand moving towards pre-COVID level, right? And it is established that inventory levels are at a multi-year low, 5, 6, 7 years low point, right? But you put that in context as well. How have policymakers and investors behaved towards energy companies, right? So if you look at the US, the shale gas players, shareholders there have been wanting a return, and they don't want shale gas producers to expand until they get a predictable return, right? The big oil companies, the governments have discouraged them from expanding their E&P output or finding new fields, right? And so at one point in time when the prices were low, they discouraged new investments, and as soon as prices went up, they want to tax these companies, right? And you're taking away some of the dollars for reinvestment, right? So the policy, I don't think, is figuring out that there is a challenge with the big oil companies as well. It could be argued that OPEC, whether it is their part of their strategy or they have also underinvested in the last few years with when oil prices were lower, and their output is not, high as well. And listen, I think the most important thing which probably people miss out is this war in Ukraine. What is it about? It is about both players, the West as well as Russia, want to win this war based on causing economic damage. How they want to cause economic damage? The West wants to say, I will make sure that your oil is shut down. There will be no more repairs from Western technology that will come to Russia, right? So I'll shut your energy output down. And how does Russia want to win that war? I will make sure that you don't get gas supplies and you will have inflation. It is really about energy from both sides. They are playing the energy game from both sides. So there has been massive underinvestments in energy. The $1 trillion or so that was invested in renewable energy is probably not giving you the desired output. So while you have curtailed supply of hydrocarbons, you have not increased the demand, right? You not curtailed the demand. So the challenge as you move forward is there a real risk when things normalize that oil prices go high? And
Right.
why is that important for us? We import 80% of our oil, right? And
Yeah.
even at $120, you're going to have 3.5 to 4% current account deficit. In a slowing global growth environment, I think we have to be careful as to how that damages our balance of payments. So my sense is that energy inflation is certainly something that is a little structural that I worry about, that can really damage the India story. And I think there are themes as I pointed out. Sure.
So how do you put this into action, Rajesh? Because you were talking about how Indian corporates are doing okay. Markets will typically be a function of what the earnings is, which may not look all that bad, at least for the near term. But there are these pressures as well. So is it that you stay neutral, sit on the sidelines? Is it that you sit on a bit of cash right now, preempting a fall? Or are you playing the tide right now and not taking a call? You will take a cash call when the tide reverses. What is it that you're doing?
So as a long short fund, I think we can be a
Of
little
course.
more tactical, right? So we can be a little more tactical. We can be aware of where the mind of the market is at the moment, and we can, position up portfolio accordingly. Having said that, it's not likely that today I believe that this is going to be a start of a bull run. So my positions will be a little more guarded, and I'm a lot more focused on the domestic themes, so that I don't face the brunt of the slowdown that you're going to see in the globe. So my focus is really domestics, keep exposure moderate, but play the tactical theme until some of these things come to fruition. Listen, the way markets work is when they move up, they move in a ladder type form. But when they move down and they realize, oh my God, this is a big risk, they take the elevator, right? So at this moment, it is still a ladder phase. There will be a catalyst that will come, which will change the mind of the market, and it will become an elevator. We have to just be cautious of when that time comes.
What goods will be a part, will be going down in the elevator? Rajesh, I'm tempted to ask. Okay, let me rephrase that question. We'll come to that in a moment. Just wondering first.
Sure.
There are companies where, for example, like Circa IT, wherein the global macro worries that you're talking about ideally should impact. But management after management is saying that this time around the recession playbook may be different because all their customers are saying that they're in the middle of the digitalization journey and they can't switch the tap off. So as much as the markets may want to believe that we will be a mirror image of what's happened probably in the past, companies are saying that this time around things may not be the same. Have you thought through this, and what is your belief on this?
So, we are equally bullish on the multi-year theme of IT.
Okay.
Having said that, I think there is some dark clouds emerging, or I would say lack of clarity emerging, both on the demand side. I think there is some slowdown that is happening from software companies in the US as well. Some of the clients are also talking about reducing spends, etc. So while that may not be as much of a challenge if it is a soft landing, but today I think it is unclear whether there is going to be a soft landing or a hard landing of the US. So there is some confusion there, and which we can't today clearly identify as to where that is going. Second is this the main cost structure of IT companies, which is relating to manpower costs. I would have believed just 15 or 20 days ago that that would have peaked. Attrition is peaking, and costs are going to come down. Some of the panic moves by some of the IT companies, if I can call it that, it's not clear to me as to what is really going on. Although I am told that some of that attrition is coming off and the lateral hires are reducing and all of that. I am not able to figure out where are we in the demand supply cycle of manpower, right? So there was a phase in COVID where they underinvested in manpower in taking more recruitments. Then demand kind of skyrocketed, and then therefore the demand for manpower also skyrocketed to another level. I don't know whether all of that is done or there is some more quarters to go. So there is some uncertainty as far as that is concerned as well. So for me, I would wait for the results. I would want a greater clarity when the results come. That's after that I will take a call as to where we are going to move from there. Tactically, therefore, we are at a lower position as far as IT is concerned.
Okay, so
because I'm not clear, I don't really know. Is the multi-year theme very clear? I think it is, but how is it going to pan out in the shorter term, the next 2 quarters? I have no idea.
That's candor, and sometimes simplicity of thought helps. So I'm presuming it's a casualty of the first concern that you spoke about, which is the global recession and what it could do. Are there other themes originating out of India which could be casualties? Maybe auto angs, I don't know if pharma, which is at a very tepid month, the month gone by. Are there other casualties of this fallout, Rajesh?
So, I would make a broader statement. I think people underestimate when things kind of slow down like this, and an environment that we are moving into, what are the things that can actually happen and what are the negative consequences, right? It's Warren Buffett says, it's only when the tide goes out that you know who's swimming naked, right? So one of the things that you should watch out for is increase in defaults globally. Higher interest rates and a slowing global economy is not a good concoction for corporate survival. And, we are ending probably a 40-year phase of lower interest rates, and at least in the last 10 or 20 years of very low interest rate regimes. And you don't know what kind of behavior it has encouraged, right? So I think I would also wait for what are the kind of casualties that will come out of this, as you move forward. There are enough people who think that this is a regime change that is taking place in the global markets. And I'm not.
It certainly seems like it, right, Rajesh?
Well, I don't have to predict it. See, the good thing is, for me, is I only understand the mind of the market and the consequence. And so I don't have to predict these macro events, but I just have to be aware, right? And as Howard Marks says, he wrote a book called Mastering the Market Cycle, where he says you can be aware as to where you are on the risk cycle. So we can just be aware. And I think there is a greater downside. There is a probability of downside is greater and consequences being on the negative side is greater given the cycle that we are in. That's enough for me to know as to how I should position my portfolio.
All right. Okay. So don't look at global themes. Now, before I come to why you like globals, let's talk about the other macro point that you spoke about, higher energy. What are the casualties are probably well known.
Yeah.
Are there beneficiaries in the Indian cycle that gain from this at all? Because we know the casualties per se, right? Aside of the macro that gets impacted, everything that is an oil consumer gets impacted or energy consumer gets impacted. Is that in the price already, part one? And two, are there beneficiaries of this trade as well?
So unfortunately, not as many. Fortunately for Warren Buffett, a lot of his incremental money has got into energy companies. So he's not buying the franchises run by good management as we would want him to be doing at this stage. He's actually buying oil companies and pouring loads of money. So that should tell you what smart money is really doing. If I could, I would buy Saudi Aramco. I looked at their profit. The profit was like close to $48 billion a quarter. Right? That's unbelievable amount of profit. So if I had access to an opportunity to buy global stocks, there are energy plays that I would play at this moment. Listen, what is happening is today with energy stocks, they are giving out dividends or buying back stock because their shareholders are telling them, don't reinvest because your valuations are too cheap, right? So their valuations either have to adjust, right, or they'll keep giving you dividends and share buybacks. So that's how the shareholders of these energy companies feel. So my sense is that that's a good spot to be in. Unfortunately, given government policy with our oil companies, it's not as easy to play that theme accurately. Although there is India's largest company that you can play based on refining margins, which has also seen a fairly low growth as far as, or negative growth as far as capacity additions are concerned.
All right. Okay. That's a very informative answer. Thanks, Rajesh, for that. And now let's talk about the domestic manufacturing piece that you spoke about, and then we'll end with what goes in the elevator. Right? We're right now still on the ladder. So everybody's talking about how domestic manufacturing, for example, is doing well. When I looked at the numbers for this quarter, manufacturing, the theme stood out. The SKFs and the Schaefflers and what have you did really well. And also what stood out was the direct to consumer or discretionary consumer themes, all of which may be coming out of a COVID demand and revenge tourism, revenge travel, revenge eating, what have you, but have fabulous numbers. So what forms a part of your core list, Rajesh? What themes?
So I think that today the consensus is auto and banking are really good place. I think on the domestic side. And I think we think no differently, unfortunately. Consumer discretionary is also going to be a good theme as you move forward, barring if ever they do give us a risk return, which is attractive. I can tell you that when I met companies in the last 1 week, almost all of them are talking about premiumization. There has been urban wage increases in the white collar class, whether it relates to IT or financial services. Across, there have been very, very large wage increases that are taking place. And that has certainly helped premiumization. So whether you're talking to an auto company, whether you're talking to a jewelry company, even real estate companies, alcohol companies, everybody talks about premiumization of the consumer. And therefore, I think that is certainly going to be an attractive theme. It's going to be a place where you can probably hide as well. Unfortunately, some of the valuations don't appear juicy enough. For us, risk return is extremely important, right? And I think that's probably getting lost a little in the Indian markets, given the amount of liquidity that is there in the Indian markets. But I would say that that is certainly a very powerful multi-year theme, according to me.
Interesting. So let's focus on where is the risk return attractive, where you can, by virtue of the nature of your fund, exercise that option as well, very, very well. What looks like being a part of the elevator on the way down? If not now, then over the next 6-12 months.
So let me add to the first question first. I would say auto is good. I would say consumer discretionary select companies are really good and they are structural in nature. I would say banking is good. I would say there are some select insurance companies which are good. Telecom companies select which are very good in a structurally a good place. So there are some of these pockets. Domestic pharma is in a good place. So there are some of these structural plays that you can play on the long side.
Okay, no, sorry. So before you answer that question, I have a follow-up there. When you speak about insurance, when you speak about telecom, there's a lot of promise there, which has been held for a number of years now. It's not quite showing, right, Rajesh? And I was looking at, I wrote a piece 2 years back. I was looking at telecom stocks world over. None of them have created wealth. There's this promise of ARPU growth happening on Airtel and Jio for a while now. It's not showing in the fortunes of Bharti Airtel at least. So why telecom? And why insurance? 3 years stagnancy now.
Well, Neeraj, I would disagree with you there a bit, because if you are seeing ARPUs have moved up in the last 2 years.
But stock prices haven't.
I wouldn't, if you look at the pure telecom stock, it has probably done reasonably well. I think the stock price was, if I can name it, we own it, so you must, that's a disclaimer. Bharti was probably 2 or 3 years ago about 400. It's now about 740 or thereabouts. So I think it has certainly do well. ARPUs have certainly moved up. I think even though the structure of the industry is now not really a duopoly, but 2 plus half player, if I may call it, I think the structure is intact for taking greater price hikes. Why are they not increasing prices, at a greater speed? I think they want to allow the consumer to absorb these price hikes. It's easy in the marketing business, as marketing business will tell you, it's easy to drop prices, but it's extremely difficult to take it up. So my sense is, I think they're allowing the consumer to absorb these price hikes. And now that they've bid for 5G, again, there is hope that they will be able to raise tariffs again. So I think they are doing it over a gradual period of time, rather than doing, one-time shock to the consumer. So, but structurally, I think ARPUs, which are one of the lowest in the world, are headed higher.
Okay, viewers, I stand corrected. September 2019, it was about 330. It's at 750. So yes, it's been a deceptively silent doubler over 3 years, which is actually pretty great returns. Okay, Rajesh, so I stand corrected. Thanks for correcting me. Now let's talk about, therefore, what do you reckon will not do well over the course of the next 6, 9, 12 months?
So I don't know what will not do well, but let us say I would be very careful with commodity companies in general, given global slowdown. It is, one can argue that if energy inflation is there, which is a key input for commodities, that therefore there are shutdowns taking place of, let us say, aluminium, and those kind of commodities can do well. But it's difficult to figure out whether demand destruction will be greater than the supply destruction, etc. At least it's not in my forte or something to kind of assess that. I would say that companies which lack pricing power, let us say asset management companies, I think, which are continuously losing market share, I think those are vulnerable. I think there are certain companies which are impacted by inflation, particularly the alcohol companies. You can see that their volume growth has been extremely anemic for the last 2 or 3 years. Their raw material to some extent is also linked to crude, ENA, etc., and other commodities, and they are telling you that the next 3 quarters also look pretty strong as far as the raw materials are concerned, and they're not getting the price hikes that they want from the governments. So there are some of these pockets that you can look at, which are stock specific. There are businesses where narratives have changed. I think the diagnostic business is one of them. I think wherever there is energy inflation and rising competition, let us say like cement, those are again, I think, going to be challenging from time to time. So what we would do at what time, I think, will depend on where we are and where the valuations are. But there are some fragilities in these themes that I can identify, which we can play when the time is right.
Got it. Great. Rajesh, this was lovely talking to you. Thank you so much for taking the time out and giving us a sense of the macro setup under which you think India would operate in the world, and then the things that you are looking out for. Lovely having a lowdown on that.
Thank you. Thanks, Neeraj.
It was our pleasure. And viewers, thanks for tuning into this edition of The Talking Point.